May get in the way of that narrative. Joining me now, Oksana Aronov, JPMorgan Asset Management Head of Market Strategy for Alternative Fixed Income. Welcome. It's good to have you.
Thank you.
No pivot? Not come in?
You know what pivot stands for, right? Pretty insane valuations on treasuries. Come on. It's really fascinating to me how rates are reacting here, given that I think that the Fed's hands are going to be tied here to deliver the kinds of aggressive cuts that are priced into this market. And, of course, we're also seeing oil moving back up, and that has been the major component driving inflation lower, not just last month, but also year to date. And we're starting to see that move the other way.
It's interesting. The market just doesn't want to believe what the Fed has to say. I mean, you saw it again today. There are various Fed speakers were out suggesting our work's not done. Core is too high. We're going to keep going, whether you believe us or not. And the market's like, whatever.
And in fact,
how long does that last?
Yeah, I think that what the Fed effectively said today is that every day that there's not a banking crisis is a day that rates are too low, right? They said in the absence of a banking crisis, they would be, or banking turmoil, they would be moving higher or setting the target higher. So how long does that last? I think that as we continue to progress through this year and we continue to see how entrenched this inflation is, because getting from 8 to 5, I think, has been a lot easier than it will be to get from 5 to 2. And really,
it's going to be more sticky.
It's going to be more sticky. I mean, we're seeing it stick certainly in core services, which is a significant portion of it. And really, as I said, the thing that's been driving it lower has been energy and oil prices, as well as some things like used cars, which are also somewhat volatile. And so as we continue to go through this year, as long as inflation remains meaningfully above the Fed's target, which let's remember is 2%, I think the Fed's hands are going to be tied here to deliver the kinds of cuts that are priced in. And, you know, as investors, we should remember that as goes inflation, so goes the correlation between bonds and stocks, which is kind of the founding, right, cornerstone on which portfolios are built, that 60-40 dynamic.
Oh, well, that was like thrown out of whack last year, as you obviously know. Before I let you go, the best play within fixed income in your world now is what?
So right now, our overarching advice to investors is preserve optionality. You've never been paid more to essentially maintain some liquidity in the portfolio while attacking opportunities as they evolve. The banking turmoil is one of the many unpleasant surprises we're going to encounter as we continue to go through the effects of this Fed hiking policy, because, yes, their hiking is closer to the end than the beginning. I think we can all agree on that.
Sounds like you're making the case for cash.
But we are just starting to see the effects of this hiking policy. And so there's going to be certainly a widening of credit spreads that investors will be able to take advantage of. And so what we've done, you know, and we run an opportunistic discipline, is attack opportunities where they have been, which is bank paper selectively in shorts, investment-grade floating paper, which moved out very meaningfully on the stress in the banking sector last month. So there are definitely things to do, but investors should absolutely preserve optionality, because this will be the year that credit punch is delivered to portfolios.
All right, optionality, the word of the day. It's great to see you. Thanks for being here.
Thanks so much.
All right.